I'm sorry I hadn't had the opportunity of being involved with you in classes prior to this time, so it's hard for me to think about the last lecture, given that my last lecture is the same as my first lecture. But that's an advantage in some sense. It doesn't necessitate that I tell you what we're going to do as far as the assignments and homework for the course. I hope this is the right room, because seeing so many of you reminds me of the time when I had my mentor and great colleague, Merton Miller, who we used to teach in the downtown program at the University of Chicago together, and it was a night program such as this, a little bit later than this. So we used to go for dinner prior to the actual teaching experience. And Merton always used to have a martini before class to quiet him down. You might have read Merton Miller's work, obviously, in your finance classes. And this one night, for a particular reason at dinner, he had a second martini. I was a little bit worried about that, but let it go. And he went to the classroom and then started to write equations on the board. And the in those days, we did write equations on the board, more so than now. But basically wrote equations on the board, and some of the students said, Professor Miller said, try to get his attention. He said, wait till I finish writing these down, and we can discuss them. And then he wrote on the second blackboard and the third blackboard, and the students were trying to interject. Finally, one student got his attention. In exasperation, Professor Miller turned to them and said, what is it? Can't you see? And I'm trying to articulate for you the theory. And they said, Professor Miller, you're in the wrong classroom. So we hope you're not in the wrong classroom today. Today I'd like to talk about liquidity and risk transfer, chaos, and the role of hedge funds. And I'll try to tell you how all these are interrelated. And maybe it'll also, for you, resurrect some of the memories from your finance classes that you've had here at the school. But I'd like to first of all talk about liquidity and risk transfer, which is an area that probably we didn't focus that much on in the finance classes, and then relate that to what I call chaos theory. And then from there, we'll dabble in bringing it back into the hedge fund world and maybe into risk management. But I'll sort of bring this up along the way. When we think about liquidity and worrying about liquidity and risk transfer, I always think there are four paths to earn returns for the provision of investment services. One way to do it, and these all relate to hedge funds or active management, is the ability to predict systematic exposures. And what I mean by systematic exposures, you might have referred to that in class, is the market factor or the growth factor, or the value factor, or the small stock factor. These are systematic exposures, potentially. Additionally, we have systematic exposures, which include such things as, the dollar versus yen, or the euro versus dollar, stocks versus bonds. So this is a way, if one has skills in this dimension, that you can forecast these particular factors, then you can obviously make money. And we've done a lot of work in classes saying, it's hard for active managers to do better than the market. So that led to the development of index funds and index factors or exchange-traded funds, in which you can buy the market without trying to forecast whether one exposure is better at the moment than another exposure. But obviously, there are macro hedge funds and macro persons who actually spend time trying to estimate systematic exposures. But basically, we think of this as a zero-sum game in that you have to predict better than others unless you have governments involved, and then the governments set up the opportunity for all of us to make money, such as when the Japanese government wants to maintain the yen low relative to the dollar and won't let the yen appreciate, and only does that for a certain period of time before speculators or can actually make money. So governments in macro policy also enable us to make money on systematic exposures. One area. The second area is probably you've all had Professor McDonald's courses or courses such as that, which is the idea of prediction of cash flows or present value analysis of some form or other, where we try to forecast the underlying cash flows of stocks and we discount those back to the present. Maybe sometimes saying 5 years from now the market can't be that smart forecasting 5 years out, so we think of normal growth 5 years hence, but estimate what our growth will be between now and 5 years from now and say this stock is overvalued because the market is forecasting too high a cash flows, whether it's the case the market doesn't understand about the quality of earnings or all the other things we've learned that allow us to be able to predict cash flows. But we have to predict cash flows and discount rates, again, better than others to make money. So that's a zero-sum game. But it has led to the tremendous growth in active management in the hedge fund industry, which is the long-short industry, where managers are forecasting cash flows, but at the same time, unlike mutual funds or institutional investing, the hedge fund person would not only think their skills would result in them being able to forecast stocks that are undervalued, but at the same time being able to forecast those stocks that are overvalued. So being able to do both presumably allows one to have a long-short strategy so that you can isolate, if you wish, the systematic exposures and concentrate a lot of your activity more so in the things you know and less so in the things you don't know by hedging out systematic exposures. So your risk is lower by hedging the systematic exposures. You increase your risk then by using leverage, bringing your risk back up again to that which might be the case if you were long only, but this way you're concentrating on your expertise. Both of those, though, again, are zero-sum game in the sense that you're superior than someone else in the business. The third area and the fourth area, which I'll work more on because I don't know that we've had much concentration on that in classes here, and I've been thinking about this recently, is the area of risk transfer and liquidity provision. Now, when I think of risk transfer, what I think of is in the way of the Keynesian way of thinking about things. That's Maynard Keynes, who you studied in your macro courses, that basically hedgers, those who are hedging risks, are willing to pay speculators to carry forward excess inventory into the marketplace. And basically we have had a change over the last number of years to the use of hedging by corporations and by investors, and that growth of hedging in the futures markets and in the over-the-counter markets, the Goldman Sachs, the Deutsche Banks, the Morgan Stanleys, etc., Citicorps, you have to realize that if we talk about the trade-off in the efficiency of capital between hedging and equity, okay, that we've seen a growth in the use of derivatives globally. That means there's a large hedging demands. Then at the same time, there has to be someone on the other side of these contracts. So not everyone could want to receive in the swap market, while someone else has to be on the other side and pay. As a result of the requirements of hedgers, or the desire for hedgers to hedge their risks, that means that we have to have speculators wanting to come into the market and provide these risk transfer services. Now, I think this area is not a zero-sum game in the sense that the hedgers know they're paying the speculators to carry the risk forward. And additionally, they would prefer, obviously, to pay less, but the more speculators there are, the lower the spreads in the marketplace tend to be, and as a result, that allows for more hedging activity. The standard example that we give from the commodity market world to illustrate risk transfer in its simplest form is take the farmer who grows wheat. The wheat comes in at one period of time. It might come in the United States, two crops, the winter crop and the summer crop. But those who store the wheat are called millers, and the millers essentially buy the risks from the farmer who sells the wheat to the miller. The miller stores the wheat. So the inventory of risk is very large because the wheat comes in at one particular moment. Now, interestingly enough, the miller has two sources of risk. One is the idiosyncratic risk. The idiosyncratic risk results from the requirement of the miller to hold the wheat in storage and then mill the wheat into flour as the bakers come to buy the flour from the miller. And then we, as consumers, buy the bread and the cakes. Okay, so the risk associated with the miller's idiosyncratic risk involve local demand-supply conditions in the marketplace, which cause there to be less demand or more demand for cake and wheat, whether Atkins diet or some other low-carb diet is in vogue. They might take risks associated with selling that wheat locally. In addition, they always have the operational risk of storage and the fact that, rats might eat into the wheat or there's spoilage, etc. So that's the idiosyncratic risk. The other risk, though, that the miller has is the general change in the price level of wheat. And the general price level of wheat could be such that over the United States that the wheat prices fall or increase depending on the crop itself or the general demand-supply conditions in the marketplace. Now, the miller can retain both sources of risk, the generalized risk or the idiosyncratic risk. The miller, however, to retain both risks, needs a tremendous amount of equity to sustain themselves against these risks. But equity is expensive because the equity in that case is only needed sporadically, once a year, and then is fallow for the rest of the year. The miller then can hold both risks with equity, but the market allows the miller to transfer the generalized risk to the marketplace through the futures market. By transferring this risk, the miller has what's called basis risk. That's the general change in the price of wheat that's involved in futures contract and the own specific or own wheat that is being stored. But the interesting issue here is there's a trade-off between equity and hedging. And this is what's permeating the miller world. It's also permeating the corporate world and the investment world. The idea is how much equity to have. You need equity, but the equity has a cost. There's a lot of deadweight cost to equity. And if you could reduce or economize on the equity you need, you could reduce the cost of holding equity relative to the cost of hedging. And as hedging increases, or the requirement of hedging, knowledge about hedging and skills increase, where we hedge interest rate risk, we hedge bond risks, we hedge equity risks in the marketplace at the corporate and individual level, this creates a demand for speculators. Without hedging, you don't get speculators. You don't get risk transfer. And as a result of that, we see a growth in the provision of risk transfer services by using hedge funds, or the idea of hedge funds providing risk transfer. And the broker-dealer community does it. The Goldmans, the Citicorps, the J.P. Morgans provide risk transfer services as part of their business. But as the risks build up on their books, they would like to transfer the risks to others in the marketplace because it's just too much risk for them to take. That leaves a role for speculators that are providing that through the hedge fund world. If you then say, look at it from the liquidity price definition, okay, that we have under Demset's world, which is an article in 1968, said liquidity is the price of immediacy services, the price of inventory risk for carrying inventory risk for risk-averse traders. So as the risk of increases, volatility increases under this modeling, then traders would like to get a higher rate of return to carry risks in the marketplace. So the price of and I want to explain why the price of risk transfer and liquidity changes in the marketplace. I distinguish liquidity from risk transfer in the sense that we think of risk transfer or liquidity in the sense of thinking of it as a spectrum of asset classes, where we think cash is the most liquid. We know you get a liquidity premium for investing in low capitalized stocks. You know you get a liquidity premium for convertible bonds, less developed country assets. And we go to private equity world. The required rate of return on private equity or restricted stock or venture capital is much higher than that required rate of return, everything else being equal, for investing in IBM. And this liquidity spectrum is the idea that in a time of a crisis, we would like to liquidate in a time of a crisis. You can't. If you're holding real estate, it's very hard to do. Or if you're holding a liquid stock, the cost of liquidation is quite great. On the other hand, cash or government bonds are most liquid. I distinguish between risk transfer and liquidity because risk transfer is bi-directional, both sides. In other words, the demand for hedging might be such that in a liquidity crisis, risk transfer could make money, and in a liquidity crisis, it could lose money. Okay, it depends on what happens, because we know in a crisis, liquidity crisis, the following things happen. We know that volatility increases in markets. We know that individuals prefer to go from the long end of the bond curve to the short end. We know that spreads widen, even though they're not really credit spreads. Credit spreads widen in the market. Equity prices fall, volatility, as I said, goes up. Commodity prices, such as gold, might go the opposite way. That's what we know in a crisis. The reverse happens when optimism is in the marketplace. So basically, those are liquidity events. On the other hand, risk transfer requirements might be such that the hedge fund or liquidity provider happens to be long volatility, because a lot of people want to be hedging by selling volatility in the marketplace. So they could be long volatility and in a crisis make money. And so that's why I distinguish between liquidity and risk transfer. But the interesting part is that the prices of all this liquidity changes in the market. So when we did our analysis and looked at portfolio theory, and we looked at the Sharpe models and Sharpe linear models, other models, they were one-period models where we could sell everything at the end of the period and reconstruct our portfolios. This is false, as we know. It's a first approximation, and we know in our theory we have to bring in our thinking we have to bring in the idea that we have the price of liquidity and the price of risk transfer are not constant in the marketplace. And all these markets need risk transfer services and pricing. And I think that the opportunity set is not constant in the marketplace. It changes over time. And the reason you need to have, reason the price of liquidity and risk transfer changes is because you need people. You need a team to analyze whether, as a speculator, whether to provide liquidity, when to provide it, and additionally, the same is true for risk transfer services. So the opportunity is not set is not constant, and the standard models do not take account of changes in asset prices because of liquidity and risk transfer services. The model of liquidity and risk transfer services that is necessary to make this work is essentially, sorry about that. Let me see if I can get back here. It's necessary for all providers to have a model of value of the underlying security. To be a speculator, you need to know model values. So that's the first step. So you need technology to have a model. Everyone needs a model because if someone says to me, Myron, I want you to buy these suits. These suits are cheap. They're very cheap. You can make money on them. Take this inventory today, speculate, hold it for 2 or 3 months, and you'll be able to sell it out. That may be true, but I don't know if I don't know if it's cheap or not. How do I know whether to buy the suits and then liquidate them? So basically, we need to have model risks. We need to estimate parameters, and we have to know whether the opportunity set is changing. Okay, and those are crucial. So I think the other questions we have to ask are, why are there deviations from the model? Why are market participants willing to pay me to take this risk off the person's hand? In the case of the miller, it becomes obvious to the speculator because the miller knows that the real money player or the inventory is accumulated here, and over here that we are going to be buying that wheat and flour to bake our cakes. So that's the real money player is going to take it off our hands, okay? That's the process. There's a time between here, at the time the services are needed, and over here when the real money players are going to come into the market and understand why market participants are willing to pay, the flows that are necessary, how long will it take to carry a position, and how do you inform ultimate buyers that they should take over the position for you. I mean, Bill Gross at PIMCO is the person who exemplifies this. Takes the position, goes on TV, and says how stupid we are not to own what he does. So, it creates closure in the system. And then ultimately, who will be the ultimate buyer, as I said, and how much capital is it necessary to provide liquidity or risk transfer services? This depends on the ability to hedge factor exposures that we have, how much rate of return are we going to make on our capital, understanding who our competition is, and getting lines of financing if we're going to be a levered player in this particular, providing these particular services. So basically then, as I said, the model is there, and then what we have in the world is sort of a division of a need to have an understanding of the market and human capital. We need teams of people. In a complex environment that we're in, the hedge fund or the persons in banks or intermediaries or providing services need to have a human capital, a team that can able to answer these questions. What's the model? What's the flows? A combination of modeling and qualitative analysis. Quantitative and qualitative analysis are necessary to actually undertake these businesses and do it in a profitable way. Have to have a contact network. Have to understand things. That's one set of requirements. And then at the same time, we need a longer horizon players, capital providers, who can provide capital to these teams to be able to operate in the marketplace. So there we have high net worth investors or pension funds, endowments, who have insurance companies have longer horizons that can provide for this capital. And what we're trying to do is, in the world, what we've seen over the last 10 years or so is really a separation of the human capital, the teams, from the capital providers or holders, and then figuring out ways to marry them back together again. So the growth of hedge funds, which I think have a role in all four of the activities that I described, that's systematic exposures, analyzing cash flows, liquidity provision, and risk transfer activities, have really arisen to be able to provide the human capital teams and then raise money or figure out how to raise money from the capital sources to provide the services that are necessary from the marketplace. The survivorship, in my view, of the funds, the ones that will survive the longest and have a business that's teachable and replicable and goes over time, are those businesses that are involved in understanding liquidity provision and risk transfer. That has, in my view, the greater survivor rate. So if we go now and ask the question, what do I mean by chaos theory, and how does it relate to the changes in the price of risk transfer services, then it's, let me describe it this way. What do I think of as chaos? We have a lot of random disordered events that occur that change the nature of our process. They're just surprises that occur. And basically, we know the following to be true. That every day we have earthquakes of 1 or 2 or little surprises, but over time we get used to these earthquakes, and we think of these earthquakes as normal. So we call that evolution. That's normal evolutionary processes. So that's the statistics we learned, and we think of this as normally distributed accumulation of all these little shocks. And time, I think, creates more disorder in the way we think about things, and more need to understand our models more. Things that we thought were for certain now tend to become less so. So there's more little shocks that occur over time. And as we have more of this uncertainty, then what it does is tend to slow down our decision-making time. Occasionally, what we would get is from time to time, we have important events occur, which might be classified as earthquakes of 4 or 5 to 7, whatever, and we notice that. So time stops when we have a very large shock, and it really tries to understand the implications of what we have. So we had a model or way of thinking about venture capital investment. We had a model or way of thinking about private equity or investments in dot-coms or whatever. And that model worked for a number of years. And then we had a shock, say, in 2000. And we realized that there was something potentially wrong with our models or how we calibrated the models. And as a result of that, time stopped. What I meant was decision time stopped. It takes time to understand models. It takes time to actually figure out what next to do. And so from that, however, it's not a closed system, because once we have a shock, even though some people might say venture capital firms are like deer in the headlights, they not doing something, they are doing something. They're thinking, okay? They're trying to understand what's happening and build new models and move forward. That's where the value of the human capital team comes in. So basically what we want to do is know what information fits the purpose, how we can solve our problem. And Einstein, who was brilliant in his way, just like us in other ways, but everything he said should be made as simple as possible, but no simpler. And models assist our intuition and help us, okay, but we know they're wrong. And salient events or shocks will really change what we have. And then innovation really arises by ascertaining what information we should throw away, how to grow, okay? And as a result of that, we end up, after the fact, with what I call sort of the law of accelerating returns again. Then as soon as we get excited about things, we learn things, we get more confidence, we build a new model, we get a new way of thinking about things, then we feed on the chaos around us and we have great growth again, and value tends to increase. So we get a new venture capital model is born, or a new private equity world is born, and we think of new ways to make investments, and we learn from these shocks, okay? So innovation occurs from chaotic events, So I like it to be the case I was given an opportunity. I went to Milan to give a talk a year or so ago, and there was my Caravaggio, who is my most favorite artist, there was an exhibit in Bergamo, which was outside of Milan. And I could have decided to rent a car and drive there myself, but there was a lot of chaos, a lot of noise. I didn't know how to drive. I looked at the map. So I decided to hire a driver, and the driver was amazing. He didn't have to even read the map. You know, he knew the chaos was, fog was not there. He was able to go directly to where it was, the exhibit. Got there, and I went. There was a 2.5-hour line in the sun, and I was standing in line, and I didn't know if I went on my own, whether I would even have gone or stood in line. And then the driver came to me, and he tapped me on the shoulder, and he said, "Come on in," and he directed me to the VIP area. And I went in there, and by the way, there are some advantages to being awarded the Nobel Prize in economics. And I got in to see the exhibit, and I saw it a couple of times. It was terrific. He then took me back to the car. We went to a wonderful place. I had lunch there, and then went back to Milan. So think about the uncertainty reduction in so much information around me, and you figure out what information to garner from that. You know, just that it is amazing. And that's the same thing that happens. That's what the value of the human capital is. That's the value of the teams. Teams in place are able to analyze more quickly and be able to figure out how to innovate from chaotic shocks, okay? There are many examples of shocks that have really changed the financial system, and I'm not going to go through all these in the time that I have, but you have the volatility of the 70s caused markets to collapse and liquidity prices to change dramatically and risk transfer costs to increase. Innovation occurred from these large salient events, and the euro, in Europe, the market actually caused recession for many years while the countries tried to be able to get into the euro. And then after the euro was born, then you got new energy, new innovation from that in the sense of more pan-Euroism and the like. And there's all these others that occur that you can really delegate as earthquakes of large magnitude where we can't say they're just a normal process. Time stops, and it really creates new innovation and new structures. So I think that options are the key, since I'm an option person and we have to relate to that, and I like that options are more valuable with increased uncertainty. So the more chaos that we have, the more uncertainty we have, then the greater the value of flexibility. But it's more costly. We have to trade off flexibility and cost. If we have this room, we have a light switch which is digital, we have it on off, okay, then it's the case that that's the lowest cost solution, but it's not very flexible. If we want it to be flexible, like having the lights being able to dim the analog system, then essentially that has greater costs. So we're always trying to think about the trade-offs between flexibility, the value of optionality, and our ability to have costs, so reduce costs. So basically, in a chaotic environment, as we become more global, and I really believe that the chaotic nature of our existence, the number of shocks we will have of magnitude 4 or greater, will become much larger over time than previously. And I think options are really the key to that. So in just summarizing here, what we have is that the process evolves. We have salient events, which are mini shocks and local shocks and global shocks that affect us all, and which will become more prevalent. And that tends to stop investment, so that we're in Silicon Valley, right, area, and at Stanford, so we have to think about new ways of thinking about things, new mushware. Then we need new software or models, and then new hardware. So with more uncertainty, the value of teams you construct and who you work with become more important and more valuable in a chaotic environment. So basically, when a shock occurs, the capital market intermediaries, the Goldmans, the Citicorps, the JP Morgans, the Deutsches, the hedge funds, the insurance companies and others withdraw capital from the market and or demand a much higher price to provide liquidity and risk services. Why do they do that? Obviously, you don't stand in the middle of a freeway when a truck is coming at you. You don't know anymore whether your model's working. You don't know anymore whether your inputs are correct. Has nature shifted from an urn, which is here, to a new urn? And how much do you weight your old beliefs versus the need for new beliefs and new thinking? So if salient events or shocks occur, then the price of liquidity and risk transfer goes up. People, the intermediaries, the speculators, withdraw capital until they have time to recalibrate their models. But that's the huge value of having a team in place. Does your team understand more quickly than other teams? If I say the market collapsed, say, in high yield before March of 2003, and people said, wow, yield spreads are great. What a great investment. Without a team to analyze it, to have a model, to understand the flows, to understand information, how is it the case one is going to enter? And that gives a huge advantage to teams in place that are actually can analyze this, but it takes them time, and prices will widen dramatically in the market, just at the same time when demanders of liquidity and risk transfer are willing to pay much more to hedge. The prices of options skyrocket in the market at that time. And you also see this reflected in common stock prices, and you can define liquidity factors where the price of small stocks, for example, go down dramatically relative to large stocks at times in which volatility spikes up or shocks occur. And the demanders are willing to pay more. And so additionally, governments tend to act to impede the adjustment process in the market. And this creates the idea that it's too smooth at times. Mr. Greenspan and others try to smooth out uncertainty, and at times a shock occurs. Like we have Yellowstone Park, where we had there that putting out fires every period of time saved the environment, and then fires were put out. However, when a huge combination or convolution of shock occurred and a lightning occurred across the park, there was myriad fires, and that caused huge damage in the park. So sometimes we don't know the right amount of volatility. We don't know the right amount of chaos to have. But trying to dampen all chaos could lead to huge shocks occurring in the economy if we intervene. And as a result of that, the price of liquidity and risk transfer could change dramatically. But I think after the shocks occur, we get new innovation and new growth occurring and new value added. So to just summarize here is that when we think of liquidity and risk transfer and hedge funds, the hedge funds are essentially, in my view, providing an economic service in that they are willing to step in and provide speculative services, whether it's in the fixed income markets or the equity markets. And the value of our human capital is ever increasing, or teams that we establish. And the reason I say teams is because of the necessity for more of us to get together and think about the problem than we can do alone. I always have felt that the Turing Test, which is about Turing deciding on whether a computer is artificially intelligent versus a man, is you put the computer and a man behind the screen, and then experts ask them questions, and if the experts can't distinguish, then we know the machine is artificially intelligent. But why would it be so stupid to put a man against the machine? We put men and women against the machine, and the men and women against the machine probably could completely beat it, because we can create teams that will be able to do that. So I think the future is very exciting for finance, and what I have done over the last year is getting more and more excited about new models, new ways of thinking about things, and technology that we can put into place. So I now have my nutritionist. I'm trying to preserve my life. I have my Pilates instructor. and I diet and exercise and the like, and to be here. So I hope I can give my last lecture 40 years from now, and hope it will be my last lecture. Thank you very much, and be willing to answer a question.
On risk transfer.
Yes.
From an economically efficient outcome, you'd want the party that assumes risk to be the party that has the lowest cost of bearing risk?
That's correct.
Would you agree that increasingly companies are offloading risk for which they are in fact the lowest cost risk bearers? Because either of superior information or experience, or because they have a lower cost of equity than, let's say, a hedge fund for which they're offloading the risk to?
Well, that's an empirical question, obviously, but a lot of the risks that, to be a company, you have to bear idiosyncratic risk. You can't make money unless you bear idiosyncratic risk. That's how the company makes money. But on the other hand, when I first started in the business, there was no way that a Goldman Sachs or a J.P. Morgan or any of the banks, for example, knew how they were making money. They didn't know whether they're making money because the price of inventory was changing or they're making money because they were turning over the inventory. Businesses make money by turning over inventory, not by taking inventory risks, okay? That's not their expertise. So basically, what we'd expect to happen is the idiosyncratic risk is retained by the corporation, and all the generalized risks are thrown away. And what we're going to see in the future is a huge separation of businesses. So risk will be transferred from corporations, those risks that they have no competitive advantage in, and retain those risks that they have a competitive advantage. Right now, the equity is a cushion, okay, against all risks. And that equity cushion is expensive because the market doesn't know, if you combine all risks into the same basket, what risks you have expertise and what risks you don't have expertise in taking. And it's difficult to measure or judge how the company is making money because of skill, luck, etc., because of the whole bundle of risks they're taking. My view, and this is a trade-off, and I didn't say I know the answer, we have risk transfer and hedging, which is costly, competes against equity that's also costly. And so we have to think of those trade-offs. I know in the last number of years, we've seen the growth to hedging and the growth in hedging. Maybe it'll revert. Maybe it'll go back. Or maybe we'll think that neither model works. Don't forget, equity is a young model. Equity's only been in existence, say, since 1900 or so. And it's a very young model, and it has a great number of flaws. You know, risk transfer in some of the things you're referring to have flaws as well. But we'll have to see. See the competitive equilibrium will be survivorship, which will survive, which will evolve. And the new infrastructures that are being put into place are trying to service this risk transfer and liquidity provision market. Yes?
Being the father of modern option theory, I'm curious to get your perspective on the
grandfather now.
Get your perspective on the recent stock option debate, and specifically how your formula is being used to value stock options for executives, and what your thoughts are there.
Well, my thoughts are that an option should be valued as a part of a compensation. Second is that I believe that the arguments are wrong that say that you cannot use options to value long-dated contracts. We see that every day. If you go to Deutsche Bank or Nomura, you know, have very long-dated contracts. Plus, the hedge funds themselves are buying very long-dated options. So the argument is specious, which say that if the stock goes down, how could we have had the right value for the option? The same way if the stock goes up. But that's confusing the valuation of what I give you from the return on what I give you. If I give you stock, okay, $100 worth of stock, and it goes to 200, what did I give you? I gave you $100 worth of stock, not 200, and vice versa if it goes from 100 to 50. So you have to distinguish those two things, and I think that argument is wrong. If we have actually fair value, if I go to an options exchange and I buy an option and the stock goes up, the question is not whether the option price, that's not a way to judge whether the option price is wrong or right. Okay, but I think that the argument of the debate should be what is the nature of the contract underlying the executive option grant. And there, the issue might be, like Bulow and Chauvin have this argument, that it's really only a 90-day contract. And their simple idea there is that if you fire an executive, that executive has to exercise her option within 90 days. And if the person leaves the firm, or et cetera. So it's a renewal of options over 90-day periods. That's an explicit contract versus an implicit contract, which says I'm going to work for the firm for 10 years. So I think that the really interesting debate, and this is something that obviously is idiosyncratic to particular corporations, is what is the nature of the contract? The vesting, what is the nature of leaving, et cetera. But I think that basically they are an expense of the corporation, and that they should be that is part of compensation and should be deducted. Yes. One more. Sorry.
On the softer side, given the importance of human capital in times of increasing uncertainty, what do you think differentiates an astounding team from a mediocre team, and what can we do to make sure that we select and form teams that can compete at that level?
Well, there's that question. I can give my last lecture, another last lecture on that, because one of the interesting parts about running a business, which I've done, I have a hedge fund that I'm sort of the leader of with my other people, and I've had to think about leadership, okay, and what that is, or running a firm, and it's a combination of leading or thinking about how you can direct people to satisfy the objectives that you want, but it's also appreciation. In other words, I think that it's necessary to be able to have a business that is, say, 80% science and 20% intuition. Because if we can't figure out a way to direct someone or train someone to do something, then you can't be sort of a leader of the team or build a team that's going to work. Second is that you have to be able to appreciate someone and what they have done. So, it's like in the Army they call it command and control or whatever. But basically the ingredients of building these teams, okay, is being able to specify objectives clearly, be able to set up ways in which you have synergistic effects, being able to talk with each other and make sure you get cross-fertilization of ideas. I separate our traders from the strategists. I don't trade myself, but I'm chief strategist or semi-chief strategist, joint chief strategist. So people who gather information and make the hypotheses and the think about things should be separate from the group that actually makes the decision about capital allocation, simply because I think that persons gathering data can be too much in the trees. Great teams can figure out how to be in the trees and then look at the forest and figure out when to do both. And I know in my organization we are not strong enough, or I'm not strong enough to do both simultaneously. So I try to separate that functionality. I think the idea of mimicking is important for team. We're taught in school not to copy, not to steal. That's baloney out there. You steal everything you can. Mimic, reverse engineer the best thing you can. And we try to learn from everyone else. That's what a team should do, and how to do that as opposed to reinventing the wheel. That's crucial. I think also framing problems that you should work on are crucial. The idea of, if you go home at night, you go to sleep, you're working on the wrong problem, that's silly. Why not work on the right problem? So the executive who walks around and has his team and says, boy, I'd like to, think pheasants are wonderful. I wish I knew where pheasant farms are. All the people rush off and figure out where pheasant farms are. That's not the right problem and objective. Additionally, I think in a team, to make a team work, you have to cross-train. The most important thing is to try to, in my office, I have flowers, I have paintings, we have seminars where everyone in the groups can go to different seminars. So this frees the mind up for creativity and being able to make the team richer. Additionally, I think having truth and trust is important. So when you tell the truth and you have constructive criticism, the team is richer than if you don't have this truthful and trusting way of interacting. And that's important in how you build it. So you have to have a feedback system. You have to keep learning. You have to be honest. And if you're not honest through feedback, you don't get, this is appreciation, you don't get the right results. And the last point that I think is so important is persistence. Don't change objectives willy-nilly all the time. Stay to discipline, because energy is dissipated. In our business, you have flows. The energy comes and you make money. And if you dissipate that energy, getting too much entropy in the system, then it's hard to restart. It takes time to restart again. So you have to make sure that you keep your energy level up and you keep your objectives and you're set on your objectives and you don't lose those objectives in how you're thinking of things. So that's it. I got to get off here. They'll throw me out of here.
Thank you.
You're welcome.